This video is about the put option, understanding its characteristics, and later we'll talk about a little more about the understanding when you're breaking even, when you should be exercising your option, the idea as a trader. So the first thing we're going to do is recognize this is an option to sell. So if we look at the illustration, you're buying a put option which expires in 21 days. You can sell 100 shares of stock at $20 each. So you have a choice, sell it or not sell it. The only reason you'd want to sell it is the $20 strike price is attractive. So in this case, you're expecting the price to go below the $20. The further it goes below the $20, the more attractive using the option would be to sell at $20. If the prices were greater than $20, you wouldn't want to exercise the option. You'd walk away from the auction and sell the stock in the market. So if we look at this line and we start with the strike price is $20 and the market price is $20, we're starting at this kink, and it's a junction of the green line, the red line, and the black line. So what we want to recognize is this is a point where you're neither making money nor losing money. You're just at the point of making money. Later we'll call this at the money. If the price goes to $22 and you had a forward contract, you'd have to go through with the deal and you'd be losing $2. But because it's an option contract, you don't have to go through with the deal. You walk away from the option and sell the stock in the stock market for $22. So you experience no losses. That's why the black line is flat. Going into the green line is making money. As the price drops, the logic would be you're selling it you sell it to the writer of the option for $20 instead of selling it in the market for $18, $17, $16. So as the price goes down, the green line gets higher and higher so that we can see clearly the buyer of the put is expecting price to drop and they don't use the option if price rises. Just for labels, so we have that flat portion where you'd be losing money if you exercise the option, and therefore you don't exercise it. We say that's the portion of the intrinsic value line. That line, the shape is called intrinsic value line. The green and the red line combined is an intrinsic value line. And we say it's out of the money. At the kink, where the green and the red meet, we call that at the money. You're neither making nor losing. You're just at the point of maybe making money. The green line is as the price drops, you're earning more and more money, so we say it's in the money. So in the money by definition is the intrinsic value is positive. At the money, the intrinsic value is absolutely zero. And out of the money, the intrinsic value is a negative number. You avoid the negative number by not exercising the option. So let's look at this table and see what I'm saying to you. Here's the strike. We deduct the market price from the strike. So strike minus market, 20 minus 22 is a negative 2. If we go to the second row, 20 minus 19.50 is a positive 50 cents. And the last one, 20 minus 19 is $1. So we would not, in the first row, we would not exercise the option to lose $2. So its intrinsic value is 0. With the middle one, we would make 50 cents if we exercise the option. So it's got an intrinsic value of 50 cents. And the bottom one, we have a $1 gain if we exercise the option, so the intrinsic value is $1. The first one would have been a negative number, would have been negative 2. We don't exercise at 0. We say it's out of the money, OTM. The 50-cent one says that I'm making money. I'm not making a lot, but I'm making 50 cents. It's in the money, ITM. And now the next one is a dollar gain. The dollar gain is further into the money. So we've now looked at where the OTM is the flat part of the curve. The rising part that's showing gains is always called ITM, and the kink is ATM. You learn that with the call option. It's simply true also with the put option. So if we go over to this graph, what we see here is the intrinsic value line, which is the black line. And then we see the red curve, which is the price curve. And notice the price is not linear, it curves. As the price moves above and below the at the money mark, out of the money and in the money, the curve changes shape. The space, vertical space between the intrinsic value line and the price line is called the potential value, where potential value is because there's time remaining and depends on the volatility of the price. So that potential value grows larger as the volatility increases, greater potential gains. But if there are losses, you don't exercise the option, so greater potential losses are irrelevant. So higher volatility translates into higher potential value, which results in a higher price. Conversely, time is always running out, so the time portion is always getting smaller. So that's the basic shape. It's always going to have that kind of curve shape. If you look at the space between at the money and the curve, that's the widest. So we see it at the money, it has the most potential value because there's a huge amount of uncertainty about which way the price is going to go. Once it's in the money, you've kind of realized some of the gain, most of the potential is gone. When it's out of money, there is no potential, so you pay very little or you pay for a little bit of potential left. The put option to sell at expiry. We're looking at a decision, should I sell it or not? So you purchase a put option on Boeing stock with expiration 45 days, strike $65, put option is 50 cents. The break even, you paid 50 cents to buy the put option, you receive 65 for the stock when you exercise the option, so your break even would be $65 minus the 50 cents, 64.50. So when we look at the view, we're saying your view when you buy a put option is the price will be below 64.50. The writer is saying he thinks it will be above 64.50. Your disagreement is about where the price will be relative to the break-even price. So here we're doing a little exercise where we're calculating the price paid for the put option. Should the put be exercised is a separate question. So we're looking at this. What is the break even? We're going to be, remember, the strike minus the put price is the break even. So the first thing would be $23.20 minus $35. So $23.20 minus $35 is the first one. The second one is going to be the $26.50 minus the $1.70. The last one, the next one is going to be $14.80 minus 10. And then we have $14.80 minus $1.50. So we've calculated the break even. Now let's take a look at the decision, should it be exercised or not. So we go over to the next page where I've completed the pictures of the value. Now what we're saying is the market price is $20. Now I want to compare the market price 20 with the strike. So if I compare it, it's below the 23.50. So this option is in the money. Again, comparing the market price with strike. The market price is less than strike. It's in the money. However, we haven't reached the break even. It's not low enough to break even. So if we look at it, what are we going to gain? We're going to gain $23 minus 20. We're going to gain $3.20. We paid $3.35. So exercising the option recovers $3.20 of the $3.35, leaving 15 cents with the writer. So the writer has 15 cents. You have gotten $3.20. If we look at B, here we see $24 is below the $26.50 by $2.50, so it's in the money by $2.50. We also see the market price is below the break-even by 80 cents. So if you exercise the option in this particular case, you're going to be able to recover your $1.70 plus more. So $26.50 minus $24 is $2.50. $2.50 is greater than the $1.70 you paid, so you're ahead by 80 cents. That's the $24.80, the 80 cents difference. Okay, let's look at C. C, the break even is $14.70, the strike price is $14.80, and the market price is $14.75. So if you exercise the option, you're going to get $14.80 minus $14.75, 5 cents. The put option was 10 cents, so you get 50% of the premium back if you exercise the option. So it's a cost recovery process in some of these. The last one, you are at $13 which is below the 14.80 by $1.80. The put option was $1.50. So you're 30 cents more than you spent on the option. You spent $1.50 of the $1.80. The extra 30 cents is your profit. So we've covered when we would exercise the option by comparing market price with strike and then market price with break even. And what we recognize is sometimes we exercise to recover part of the price we paid for the put. Other times we exercise to make money. So that completes the put option section.